refresher course today, the afternoon session. The two sessions we have Professor B. Mahadevappa, Professor in Commerce, Hemagangotri, University of Mysore, Hassan. So Professor has 29 years of experience in a PG level. Before joining university, he was in a Board of Workers' Education, Ministry of Labour, Government of India for about 8 years. And he was instrumental in upgrading the Department of Studies in Commerce as a UGC SAP department. And he has got around 55 lakhs of UGC grants to the university. And he is also a postdoctoral research fellow of University Grants Commission India. As a researcher, he has successfully guided 13 research scholars for their PhD. And his area of research includes TQM practices in manufacturing, services industry, and evaluation of accounting practices of NPAs, and social accounting, value-added accounting, accounting for price level adjustment, extensible business reporting language, international financing reporting standards, and Indian accounting standards. He has partnered with CII and NASCOM and enabled the UGC interaction, University Industry Interaction. He was also a director for 3 years in University Industry Interaction Center of University of Mysore. He has authored around 41 research papers. Out of this, 403 researchers have indexed. There were H index of 5 to 10 and I-10 index of 5. He has presented 36 research papers in both national and international seminars. He has visited Australia, Thailand, and Taiwan to present research papers in international conferences held in 2012 and 2009 and 2006. He was also a member of state level textbook revision committee, DSCRT, Government of Karnataka, and undertaken national level curriculum framework. He is a member of many professional bodies, Indian Accounting Association, Indian Accounting Research Foundation, Quality Circle Forum of India, etc. Today we have with us Professor B. Mahadevappa, who will be deliberating in the first session on deferred tax accounting, and the second session on budget estimates and accounts for universities and colleges. Sir, we welcome you, sir. Thank you. Sir, for your information, we have around 38 participants, and 10 are from Tamil Nadu, and 1 from Assam, and 1 from Maharashtra, rest of them from Karnataka, sir.
Good representation of India. Yes.
Yeah. Thank you, sir. Over to you. I'll leave the session, sir. Thank you.
Okay, good afternoon. I think you are seeing the slides.
Not visible.
Not
Sir.
it, sir. Not
Yeah.
it.
No, sir.
Yes, sir. Just a moment.
Is it visible now?
Yes,
Yes, visible now.
Yes,
Yes,
sir.
yes, sir.
Okay, good afternoon. In these two sessions, the first session we focus on deferred tax accounting, deferred income tax accounting. This is a subject, interdisciplinary subject involving the Provisions Tax Act 1963 and also the Companies Companies Act 2013 and accounting standards. How we measure the income, how we show the tax on income differs from accounting provisions to the income tax provisions. This is my subject for first session. These are my aim of presentation, what we are going to discuss in this first session. First one is why there is a difference between taxable income and pre-tax accounting income. I think most of us, we are teaching accounting and also income taxes for degree students and postgraduate students. And we want to know the taxable income is calculated as per Income Tax Act, pre-tax accounting income is calculated as per Companies Act. Why there's a difference? This first question. Second question is why deferred tax asset and deferred tax liability arise in financial statements? If you have seen the annual report of companies, in the balance sheet, it is shown deferred tax asset on the asset side and deferred tax liability on the liability side. Why it is shown? Third question is which are the requirements of India's 12 income taxes and how accounting for income taxes are practiced? These are the questions we have raised for the discussion. I make presentation in between. If you want to ask, you can ask questions, or later you can have a discussion on the subject. All of us are very familiar with what is the definition of accounting. This is one definition, very simple definition. Accounting is an information system. We use input, we process them, output we create, and users are there. Input means all business transactions are input. Process means manual accounting or computerized accounting. We start from journal entry, ledger, trial balance, balance sheet, profit and loss account. We produce the output. This output, profit and loss account, why we call it as a financial statements, are meant for users, shareholders, public, students, teachers, etc. This is the structure of our accounting process. This process, input, output, and users. Accounting process, we record the business transaction journal ledger. Some disturbances. Shall I continue?
Continue, sir. Continue.
Accounting process. We record the business transactions in the form of journal and ledger. For example, if you use the tally gives the journal, daybook, ledger, and also the financial statements. We prepare the profit and loss account, trial balance, balance sheet. While recording the business transactions and preparing financial statements, we follow some accounting principles, rules, regulations, standards. These are as per the provisions of the Companies Act 2013 and also Accounting India's Indian Accounting Standards mandated by the Ministry of Corporate Affairs through the Institute of Chartered Finance, Institute of ICI. There are several acts are there. Main important acts for us is Companies Act 2013 and Income Tax Act. These two acts we practice. Why means we want to determine the net profit, profit before tax, net profit, etc. under the Companies Act. Under the Income Tax Act, we have to find out the taxable income on which we have to pay the tax to the government. These two acts we use, provisions of these two acts. Income Tax Act and its rules, you are all familiar with that. Income Tax Act rules are followed by the companies to file the income tax returns every year on the basis of the audited financial statements. Often, there's a conflict between provisions of the Companies Act and also provisions of the Income Tax Act with regard to recognition of expenses and recognition of income in the profit and loss account. Measurement, either do you use the depreciation, for example, do you use the straight line method or return on value method, or valuation of stock, do you use the FIFO method or LIFO method? Measurement methods are different. And also the disclosure of financial information is also different in two sets of accounting. One is financial accounting, another one is tax information. They are different because basically the rules, the provisions under the Income Tax Act and accounting or Companies Act are different. Tax information, if you see the annual report of companies, quarterly financial statements or annual financial statements which are available with the stock exchanges, because companies need to file the returns, different statements as per the LODR requirements under SEBI 2015. So when you look into the financial statements of any companies, you find here current year's tax liability, deferred tax liability, and deferred tax asset. This is three items you find. Current year's tax liability is the tax liability of the company. As per the Income Tax Act, you have to pay to the government. Basically, we have to pay the advance payment of tax. Later, we have to adjust the advance payment of tax to the net tax liability of the company. And there are another two important items in the balance sheet: deferred tax liability and deferred tax asset. That leads to deferred portion in the income tax profit and loss account, current portion and deferred portion. I think if you have seen it, we can also look into some of the annual report if we wish. Taxable income is the income determined by applying the measurement rules of Income Tax Act. All of us, we are familiar, 5 heads of income. For corporate accounting, for corporate income tax, salary income will not come. Other heads will come. Income from house property, business head, capital gains, and income from other sources. We determine the total income, gross total income, after applying a set off and set carry forward of losses as per the Income Tax Act. This taxable income is computed to determine the amount of income tax an assessee must pay. This we say as current tax liability. Current year's tax liability is based on the taxable income determined as per the income tax rules. Tax liability, if you apply the formula, current tax portion, there are two portions in the current tax liability. What is current tax portion plus deferred tax portion? Current tax portion is the current tax liability, which is equivalent to total income of the company multiplied by current tax rate. Deferred tax portion, another portion in the tax liability, is the sum of the deferred tax liability and deferred tax asset. We have to learn why these two will arise in the financial statements. So deferred portion is the sum of deferred tax liability and deferred tax asset. There is another concept called profit before tax. We are all familiar with PBT. We call it as a pre-tax accounting income. Pre-tax accounting income means accounting income wherein we have not deducted the tax. Pre-tax accounting income has no effect on the amount of income taxes actually paid, as it is computed for financial reporting purpose. We are not applying the income tax rate on the pre-tax accounting income because tax rate is applied to taxable income, which has been calculated on the basis of income tax rules. But in the profit and loss account, we have two figures. One is PBT less tax. Later we get PAT. Therefore, our argument is that PBT has no effect on the amount of tax we are paying, which is not taken as a base for calculation of income tax liability. Income tax amount is deducted from the pre-tax accounting income to determine profit after tax. So we deduct the tax liability, which includes current portion and deferred portion, and we get the profit after tax. There is a difference. There is a difference between taxable income and pre-tax accounting income. I think you are very clear about this. Taxable income is calculated as per tax reporting. Accounting income is calculated for financial reporting. These two types of reporting, we call it as a dual reporting. In India, we are practicing dual reporting. One sets of accounts for tax authorities, another sets of accounts for authorities under the Companies Act, means Register of Companies or the stock exchange. Why there is a dual reporting? There are countries in the world where they are not practicing dual reporting. Suppose we get salary, we have to pay tax on salary. We cannot find another tax. We are paying tax on salary. Of course, we deduct some deductions as per the Income Tax Act. But in case of companies, they encourage dual reporting, one for tax purpose, another for financial reporting purpose. Always you find the difference between taxable income and pre-tax accounting income. Taxable income follows the provisions of the Income Tax Act. Accounting income follows the provisions of Companies Act, accounting standards, regulations, and SEBI regulations and RBI regulations. There are regulatory bodies. They have some regulations. We have to follow the regulations. For the listed companies, we have to apply the SEBI regulations. For banking companies, RBI regulations. For insurance companies, IRDA. Like this, separate sectors will have their own regulatory bodies. We have to follow this. But for income tax purpose, I think we are not following all these things. We have to follow only the provisions of the Income Tax Act. Therefore, there's a difference between taxable income and pre-tax accounting income. The question is, why there is a difference? Why there is a difference? Difference is because of the differences in the provisions. These different rules and provisions will lead to a concept called timing differences. What is timing differences? Very important concept in deferred tax accounting. Timing differences, profit considered for tax purpose is different from profit shown in profit and loss account. This you agree. These differences are called timing differences. They originate in one accounting period, they reverse in another accounting period. There are two types of differences we discussed later. One is permanent differences, another one is temporary differences. The temporary differences, that temporary means temporal. Temporary means temporal. The differences are temporal because they arise in one accounting period and they reverse in another accounting period. This we call it as a timing differences. There are two types of timing differences. One is permanent differences, another one is temporary differences. These differences are the reason for differences in the taxable income and pre-tax accounting income. Conceptually, we say that taxable income is different from pre-tax accounting income because there are permanent differences and also temporary differences. Let us understand what do you mean by permanent differences and what do you mean by temporary differences. Permanent differences is created when income element, revenue gain, expense or loss enters the computation of either taxable income or pre-tax accounting income, but never enters the computation of the other. I think you must understand this definition clearly. Any item of revenue or gain which enters the profit and loss account, but not the income tax calculation of computation of income, business income. Any expense or loss which enters the income tax or it will not enter the accounting. Means while computation of total income under the Income Tax Act, some expenses are there, some revenues are there, some gains are there. But such gains, revenues, expenses or losses will not appear in the accounting. We call it as permanent differences. This difference is permanent. There are many examples are there. Take the example of tax-free interest income. Interest is tax-free on most government securities for tax purpose. Section 10 deals with the exempted incomes. When interest is an income, which is tax-free, therefore you are not adding in the computation of total income under the Income Tax Act. Though it is a tax-free, we cannot exclude it under the income tax accounting. We have to show it in the profit and loss account. Suppose the tax-free interest income of a company is 1 lakh rupees. You are excluding in the Income Tax Act, but you are including under the Companies Act in the profit and loss account. You cannot exclude in the profit and loss account because it is an income, though it is tax-free, you have to show it in the profit and loss account, but you are not showing it in the total income. This difference is permanent. Why it is permanent? As long as some interest income is tax-free, they are not included in the taxable income. Therefore, it's a permanent in nature. Dividend was tax-free earlier, not now. This is earlier it was tax-free, not now. It is taxable. We exclude that. Now dividend is taxable in the hands of shareholders. Fines and penalties. Income Tax Act will levy fines and penalties for violation of law. These are not deductible expenses under Income Tax Act. Suppose belated submission of return. For belated submission, late submission of return, Income Tax Act will levy some penalty fines. These are expenses, but you cannot show in the total income. You cannot claim deduction to the Income Tax Act because the Income Tax Act will not encourage the assessee to delay the submission of return and claim the deduction of such a delay, means fines and penalties. But if you come to the profit and loss account, any fines levied by any regulatory body is an expense. We can show it in the profit and loss account debit side, but you are not showing it in the total income. This is a permanent difference. Disallowed expenses. There are many expenses under the Income Tax Act which are disallowed for computing taxable income. For example, goodwill written off. You show in the profit and loss account goodwill written off as an expense. Amortization of goodwill, patent, intangible assets. But in Income Tax Act, you don't deduct the goodwill written off as an expense. if it is allowed, I think many companies would have shown the goodwill written off, and their total income would have been less compared to without deducting that. This is disallowed. Disallowed expenses are there under the business side. There are many disallowed expenses. These are not allowed in the Income Tax Act, but they are allowed in the Companies Act. So I sum up. There is a difference between income under the Income Tax Act and profit under the accounting because of permanent differences. Permanent differences means any income or revenue, any expense or gain comes in total income, but not in profit and loss account. Okay, this is examples we have given. Any questions if you have, we can discuss later. Now we come to the temporary differences. What do you mean by temporary differences? A temporary difference arises with the measurement rules for financial reporting as per Companies Act or Ind AS is different from the Income Tax Act. Measurement methods, they're different. Suppose the best example is depreciation for Section 32 under the Income Tax Act. Section 32 says that you should follow WDV method. Whereas Companies Act doesn't tell you to follow either company. You can follow the WDV method or you can follow the straight line method. So temporary differences arise when measurement methods are different under two sets of acts. Because the timing of recognition of revenue, gains, expenses, and losses, assets, liabilities is different. Therefore, we call it as a temporary difference. This temporary difference affects the computation of either taxable income or pre-tax account income in one period, and in subsequent period they reverse. What does it mean? You take the depreciation example. The amount of depreciation you provide for an asset during the early years under the WDV is more. In the later years, it is less. Whereas the straight line method, you give the same amount of depreciation for all the years during the life of the asset. So in sum, you can say that the total amount of depreciation is same, but the period you give more depreciation in the beginning, less depreciation in the later. We call it as a reverse. The differences arise, but it reverses later period. Therefore, it affects the computation of either taxable income or pre-tax accounting in one period. Later period, it reverses. We study the expense examples also. Temporary differences are temporal. They are not permanent. Means they originate in one accounting period and they reverse in another accounting period. Their effect is zero. The net effect is zero. But during these periods, they lead to arise deferred tax asset and deferred tax liabilities. Depreciation amount. WDV method is used for computing depreciation with Income Tax Act, while some alternative method is used for financial reporting. So, for example, straight line method. If you compare the straight line method and WDV method, larger amount of depreciation is deducted for tax purpose in the beginning of the asset, while lower depreciation is deducted in the later years under the WDV method. Whereas in SLM method, same amount of depreciation is given. Therefore, there will be a taxable income difference. As you provide more depreciation in the beginning year, taxable income will be less. But in later year, your taxable income will be more. Therefore, tax liability will be different. Whereas in accounting, you follow a straight line method, there will be no difference in the tax liability under the accounting. For example, you take the example, original cost of the asset is 10,000 rupees. Life of the asset is 10 years. Residual value after the end of the asset is 100. What is the amount of depreciation on the WDV method or straight line method? I think it is a very easy example. If the rate of depreciation is not given, you have to follow the formula, use the formula to find the depreciation. Under the straight line method, cost minus residual value, so 10,000 minus 100 rupees, 9,900 divided by 10 years, you get 990 per year of depreciation. So rate of depreciation comes to 9.9% under straight line method. Under, suppose if you show the straight line method, here 10 years are there in the first column. Cost minus depreciation, WDV, 10,000 minus the depreciation amount. You see at the end of the 10 years, you will get 100 rupees residual value in the second column. In the third column, you get the total amount of depreciation 9,990. Means if you follow any method of depreciation, amount of depreciation is same throughout the life of the asset. But in each year, the amount differs. We show that, study the table later. If you go to WDV method, If the rate of depreciation is not given, then it will be calculated by using the formula. I think you are familiar with the formula. Rate of depreciation is equal to 1 minus nth root of residual value divided by cost. Residual value is 100. Okay, cost is 10,000 rupees. You get 0.01. 10th root of 0.01, you get it 36.90%. See the rate of depreciation. The derivative is 36.9%, whereas in the straight line method is 9.9%. There's a difference in the rate of depreciation of the two methods. If you see the calculation of the WDV method, first column 10 years you take on. The second column WDV, cost minus depreciation. The third column, you have applied the depreciation percentage under the WDV method. It is 3,690 like this. In the second column, if you look into after the 10 years period, you get 100 rupees residual value, which is equal to 158 WDV in the 10th year minus 58 rupees depreciation, which is equal to 100 rupees residual value. Total amount of depreciation is 9,990. See the third column. Total amount of depreciation is 9,990 under the WDV method. And if you go to the straight line method, the WDV depreciation amount is same. Our argument is that if we follow any method of depreciation, amount of depreciation for the life of the asset remains same. But amount of depreciation chargeable to profit and loss account each year, it varies from one method to another method. This we have seen here, the total amount of depreciation under the two methods. So this is our hypothesis. Total amount of depreciation provided under WDV method or straight line method is 9,900 for the life of the asset. There is difference in the amount of depreciation provided in each accounting year under WDV method or straight line method. Each year there is a difference, but for the whole life of the asset it is same. Our third hypothesis, WDV method provides more depreciation during the first 3 years, around 7,488 rupees. Approximately 75% of the asset, cost of the asset is given as a depreciation to the WDV method. Means Income Tax Act encourages WDV method because assessees are benefited by giving more depreciation in the initial years of the asset. First year you have given 3,630, second year 2,329 plus 1,469 in the third year. Whereas in the straight line method, total amount of depreciation given is only 2,412. This is next 7 years you are giving 2,412. Means 75% of the depreciation is given in the first 3 years. Remaining 25% is given in the 7 years. I think you would apply 20-80 rule. Approximately 80% of the depreciation is given in the 20% of the year, and 20% of the depreciation is given 80% of the asset life. That we can approximately conclude under the hypothesis 3. Hypothesis 4, straight line method provides equal amount of depreciation in each accounting period, means 990. There is no variation at all each year. Total amount at the end of the 10th year is 9,990. What is the implication? We have studied the example of a depreciation under the straight line method and the WDV method. What is the impact of this difference in pre-tax accounting income and total income, and what it leads to deferred tax accounting? This is a very important significance in the deferred tax accounting. You can see you have made a comparison here. Temporary differences, we call it as a temporary difference because it arises in 1 year, reverses in next year. Suppose in first year, depreciation amount is 3,690 WDV method. SLA method 990. Difference arises 2,700. This is called temporary difference in the year 1 because of changes in the method of depreciation. Second year, under WDV method 2,329 you have given. Under straight line method 990, 1,399. Third year 1,469, 990, 479. You see positive figures here. Whereas in the fourth year, depreciation given under straight WDV method is 927, less you have given. Whereas in straight line method 990, it results in minus 63. In later years, you can see minus figures. The beauty is in the second column, total amount of depreciation is same, 9,900. Third column, it is same. Whereas in the last column, 0 at the end of the 10th year. It means there is no difference at all at the end of the 10th year. Same, it is same. Differences arises, but reverses during the life of the asset. This is our argument. If you have any question, you please ask before going to the next slide. Just I want to clarify these calculations. Any questions you have?
No, sir.
Oh, you understood. I think no questions regarding the tables. Very simple example.
No, sir.
Okay. This is the conceptual base for deferred tax accounting. There are many such differences. I have taken only depreciation. You can take LIFO, P4 method for valuation of stock. Okay. Recognition of income and expenditure. There are many differences are there. If you go to the income recognition, expense recognition, there are many differences you can find. For example, you take the bad debts, reserve for bad debts. Okay. Goodwill written off, preliminary expenses written off, many such recognition, measurement methods, how an accountant will use, how the income tax authorities will accept them. There's a difference that leads to temporary differences. These are not permanent differences. This will not have any effect on tax liability of the company over a period of 10 years. The effect is temporal, that will be reversed in the later years. So, based on the example given in the earlier slides, larger amount of depreciation is deducted for tax purpose in the early years of an asset life, while lower depreciation is deducted in the later years under the WDV method for tax purpose. This is our observation. This you have seen in this table. More depreciation in the beginning year, less depreciation in the later year under the WDV method. Higher depreciation amount deducted under IT Act during 3 years of asset life, around 4,518, is reversed by deducting lower amount of depreciation during next 7 years, that is more minus 4,518, therefore results in 0. You can see here in the table, you see here, last column you can see 2,700 plus 1,399 plus 2,479, you total it. This is a positive figures. These positive figures will be reversed by negative figures. So it means 4,518 plus is reversed in minus in the next year. That results in 0 in the last column. Some of the difference in the depreciation under straight line method and SLM method is always 0 at the end of the asset life. This is our hypothesis. Some of the differences for 10 years is always 0. I think you remember while teaching the standard deviation, some of the deviation from the mean is always 0. We tell our students some of the deviation from means arithmetic when you have taken and deferred the deviation, there will be plus and minus. It is always 0 like that. Some of the differences in depreciation amount between straight line method and WDV method is always 0. This is a very important concept under the deferred tax accounting. We take several examples. I said prepaid expenses, for example. Many examples are there. We follow accrual system of accounting and cash system of accounting. Income Tax Act recognizes cash system of accounting, whereas financial accounting recognizes accrual system of accounting. If you have seen the annual report of any company, notes to accounts, the first point is basis for preparation of accounting. They say, companies will say, accounts have been prepared by following accrual basis under historical cost system. Invariably, if you see any annual report, these two assumptions will be there. So, cash system is not followed for preparation of financial statements under the financial reporting. What is the difference? This basic system in accounting results in prepaid rent, prepaid insurance. Similar items are reported as assets and expensed over the period of usage for financial reporting. Suppose insurance should always be paid in advance. Suppose if you want to insure a vehicle today night, midnight, the risk will commence. I have to pay the insurance amount in advance, but the benefit I receive for next 1 year. When a company pays the insurance in March for the next year, 31st March you are given, you show it as an expense in the financial reporting. Okay, for next year you are showing, but if you follow accrual system, you are not showing it as an expense because that will be taken to the next year accrual system that belongs to the next year. Whereas in income tax, since cash is paid, you have to show it as an expense in the March itself. So there's a difference between cash system and accrual system. We teach accounting to our students through accrual system, whereas income tax authorities will follow cash system. They always look into whether cash is paid, cash is received. I think we cannot say exactly cash system because income tax total income is calculated on the basis of accounting profit and loss account in the balance sheet. Cash system is followed for some items. For example, excise duty, GST due but not paid. Income tax authorities will not consider that. You have to pay the tax, they will consider as a deductible expense. So this cash system and accrual system, there's a difference. Prepaid expenses, it has two portions. Current portion, which is expense, deferred portion, which is asset. So any prepaid expenses is there, which belongs to the current year, we can show it in the profit and loss account debit side. Any expense which is not related to the current year, we show it as a deferred portion in the asset, as an asset. Prepaid expenses and asset, the balance sheet we show. Two portions, current portion and deferred portion. Example, prepaid rent on 1/3/20 is 7,000. I've taken the March month. Rent per month is 1,000. 6 months rent from April 20 to June 20 is paid in advance. So you have paid 7,000 rupees in the March. You have paid 1,000 for this year, 6,000 advance for next year. Under the financial reporting, you show 1,000 as an expense in the first year, in the first 1920 year, in the profit and loss account. 6,000 is shown as an asset. If you go to income tax, since you have paid entire amount, it is shown as an expense. Means including 7,000 rupees, 1,000 rupees is shown as an expense. Therefore, tax audit will be conducted by the tax authorities. Tax authorities need tax tax audit report. This will be done by chartered accountants. Chartered accountant will do two types of audit. One is financial audit, another one is tax audit. If you want to file a return for companies or non-profit operations, you have to conduct a tax audit and you have to submit the tax audit report along with the your files, income tax filing. Income received in advance. Rent received in advance is reported as liability and later it is shown as income under the accrual basis for financial reporting. But they are shown as income for tax purpose under cash basis. Means the income which is not earned this year, this is a liability as per the accrual system. We are showing it in the liability side of the balance sheet. Whereas for tax purpose, it is shown as income for cash basis. You are following the cash basis of accounting. So we have studied some examples of temporary differences. Only few examples, depreciation example, income received in advance, expenses paid in advance like this. There are many such examples are there. Our main concern is what is the impact of these temporary differences? What is the impact? How do they influence? These temporary differences originate in one accounting period and are sometimes referred to as originating differences at the time period. What is originating differences? Suppose we have seen in the income in the table, in this table, this 2,700 is the difference between the 3,690 and 990. This difference has arisen in the first accounting period, second accounting period 1,033.39, the third financial year 479. These differences have arisen. Whereas in the later years, they reversed. We call it as originating differences, where the differences arise, where the differences have been reversed. Temporary differences originate in one accounting period and are sometimes referred to as originating differences at that time. We have seen 3 years, first, second, third year, we have seen the depreciation differences arise. Later, they turn around or reverse in one or more future periods and are referred to as reversing differences at later time. In our example, first 3 financial years, there's a difference. This difference is reversed in next 7 years. This we call it as how the differences arises and also differences reverses in accounting and income tax. This difference, there are 2 types of such temporary differences. One is future taxable amount. What is future taxable amount? The temporary differences lead to future taxable amounts. Future taxable amounts are temporary differences that arise that increases tax income related to pre-tax accounting income. Taxable amount means some income we have not shown in the income tax, therefore there would be increase in the taxable income later year compared to pre-tax accounting income. I would repeat again, Future taxable amounts refers to temporary difference that increase taxable income compared to pre-tax accounting income in future periods when the reverse occurs. Second one is future deductible amount. One is future taxable amount, another one is future deductible amount. Future temporary differences that decrease the taxable income related to pre-tax accounting income in future periods when reversal occurs. I think we have seen plus and minus in the depreciation difference. One leads to liability, other leads to deductibility, means liability will be reduced, tax liability will be reduced. So there are two concepts. One is future taxable amount, another one is future deductible amount. This is an example. You can see future taxable and future deductible amounts. Common sources, where they arise. Examples. What is the result? Revenues and gains, first column I am reading. Revenues and gains are included in the pre-tax accounting income but not in the taxable income. For example, interest income accrued but not received. We call it as outstanding incomes. Accrued but not received. When it is accrued, we show it as an income under the profit and loss account. But in income tax, we don't consider it. It results in deferred tax liability. Interest income accrued. So, for example, 1,000 interest income accrued on 31st March 2023. 1,000 rupees is shown as income under the accounting, but in income tax it is not shown. That will be shown in the next year. Therefore, it results in future taxable amount. We call it results in deferred tax liability. Second example is third row. Revenues and gains are included in taxable income, but not in pre-tax accounting income. Interest income not accrued but received in advance. Income received in advance. Deferred tax assets. I have given a very simple example. Suppose if you want any clarification, you may ask later. How deferred tax liability arises? How deferred tax assets arises? They arise because there is a difference in conceptual difference in treatment of income and expenditure under the Income Tax Act and Companies Act. We are given in the footnote. Rationale for differences, cash system versus accrual system of accounting is the difference for results in deferred tax liability and deferred tax asset under the third column. Second column, examples. The first column, what is the common source of such? Another examples here. Expenses, first column I am reading, expenses or losses are deducted for taxable income but not pre-tax accounting income. For example, expenses paid in advance, prepaid expenses, that results in deferred tax liability. Expenses or losses are deducted from pre-tax accounting income but not the taxable income. We call it as expenses due but not received, paid, outstanding expenses, deferred tax asset. The rationale for such differences is, again, cash basis of accounting and accrual basis of accounting. So we have seen some examples how the deferred tax asset and deferred tax liability arises in the profit and loss statement. I come to the beginning when I say that profit before tax figure, less tax, tax has got two portions. One is current portion, current tax liability, which is equal to total taxable income of current year multiplied by tax rate. Another portion is deferred portion. Deferred portion results in deferred tax liability and deferred tax asset. We go to the next conceptual basis, which is the conceptual basis underlying the accounting for differences. Conceptual basis. The conceptual basis underlying accounting for one minute. The conceptual basis of accounting for deferred income taxes is the measurement of the future income tax effect or benefit or obligation that arises from the current temporary differences. How the current temporary differences, temporary differences arises in this year, which lead to two types of one is future economic tax benefit or future tax obligations. Means one is asset, another one is a liability. We have a method called asset liability method. Ind AS, income taxes, recognizes two methods. One is asset liability method. This is a method for determining deferred tax asset and deferred tax liabilities. The asset liability method is used to account for temporary differences. Under the asset liability method, the future tax consequences arising from the temporary differences existing at the end of the accounting period are recorded as either deferred tax assets or deferred tax liabilities in the financial statements. These are shown in the financial statements. In the tax reporting, I think this will not come under the income tax. Income Tax Act says only what is the total income, what's the tax payable, how much advance income tax has been paid. Sometimes MAT provisions will come. This will not come under the income tax. These deferred tax assets and deferred tax liabilities will come only in the financial statements, in the profit and loss account and also in the balance sheet. So deferred tax asset and deferred tax liability concept has arisen because we have followed the asset liability method for accounting for temporary differences. First one is deferred tax liability. I think we already seen the example. Future taxable amounts result in future tax obligations because they cause an increase in the future taxable income compared to pre-tax accounting income. Therefore, they are called deferred tax liability. Please understood this one. Future taxable amount. Which are the future taxable amount? We have given the examples earlier. Future taxable amounts results in future tax liability, future tax obligations. Therefore, it is deferred tax liability. Opposite to this concept is deferred tax asset. Future deductible amounts result in reduced future tax obligation. Therefore, it results in deferred tax asset because they cause future taxable income to decrease related to pre-tax accounting income. If you compare the taxable income under the Income Tax Act and pre-tax accounting income to the Companies Act, there will be difference. This difference will be either creates more taxable amount or it may create deductible amount. If future deductible amount has been created by the temporary differences, that results in deferred tax asset. Deferred tax asset and liability measures or estimates of the future tax cash flows, consequences of existing temporary differences. Means how the cash inflow or outflow, future tax cash inflow or outflow arises because of the deferred tax assets and liabilities. If you come to the current portion of the income tax, as per the Income Tax Act, current portion of the income tax expense for a period is computed on the basis of heads of income under the Income Tax Act. I think we are familiar with that. And also we avail some deductions into the Income Tax Act. Tax payable for refundable for the year is current portion of the income tax expense or savings. This we have seen in the profit and loss account, current portion. We have another portion in the profit and loss account. This portion is called deferred portion of income tax. There are two portions in the profit and loss account. The changes in the balances of deferred tax asset and the deferred tax liability amounts from the beginning to the end of the accounting period are included in the deferred tax component. Means every year you carry forward deferred tax liability and deferred tax asset in the balance sheet. Opening balance. This year there are temporary differences that may add to the deferred tax asset and liability. Therefore, there's a closing figure of deferred tax liability and deferred tax asset. The difference in these two figures are shown in the profit and loss account. Like I think we are familiar with the carry forwarding the balances of the asset side and liabilities. Deferred tax asset and liabilities also carried forward from 1 year to another year. Beginning period, additions or deletions in the current year, and closing balance. That calculation results in deferred portion of income tax. We have seen the calculation here. Deferred portion of the current year's income tax can be calculated by using the following steps. A, temporary difference at the end of the year into tax rate. Closing balance, that is deferred tax asset. Closing balance, deferred tax liability. Temporary difference at the end of the last year tax rate, opening balance. We have opening balance, closing balance. Means temporary differences at the last year, temporary difference at the current year. Tax rate may be different or same. You take the applicable tax rate. Deduct in the step C, deduct B from A. Means find the difference between opening balance and closing balance. Deferred portion of current year's income tax savings in the asset column. In the last column, deferred portion of the current year's income tax expense. What is the net effect? If deferred tax asset is more than the deferred tax liability, then current year's income tax payable is less because future tax deductible amount, it will be less in the second column. In the third column, if the deferred tax liability is more than the deferred tax asset, then current year's income tax payable is more. I hope that I have summarized in the previous slides. Future taxable amount, future deductible amount. If we have a deferred tax asset opening balance, closing balance, the difference is there. Apply the tax rate. If deferred tax asset is more than the deferred tax liability, then current tax liability will be reduced. If the deferred tax liability is more than the deferred tax asset, then current year's income tax liability will be increased. The net effect is called deferred portion of income tax. It results from these calculations. Algebraically, suppose if you apply the formula, deferred tax portion of the income tax expense or savings, which is equal to increase or decrease in the deferred tax liability plus increase or decrease in the deferred tax asset multiplied by tax rate. You apply this formula, you find the deferred portion of the income tax. What is the total tax expense of a company for a year, which is equal to two portions? One is current year portion, another one is deferred portion. Current year portion, taxable income multiplied by tax rate of the current year. Deferred portion is the difference between the deferred tax asset and deferred tax liability, opening balance, closing balance, and current year's addition or deletions. Okay. I think we go to the case study. X Limited has following information for the year 2021. These examples we can take from the annual report of the companies also. Corporate tax rate 25%. Pre-tax accounting income, that is called PBT, 4 lakh. Taxable income, 2 lakh rupees. Prepaid insurance premium, 20,000 rupees. This is a temporary difference. What temporary difference is there? Pre-tax accounting income is 4 lakh. Taxable income is 2 lakh. You know, the taxable income is always less because companies would avail so many concessions and reductions to the Income Tax Act. Therefore, their taxable income will be less. Therefore, if you find the effective tax rate of companies, the effective tax rate is very less compared to the statutory tax rate. Even though tax rate is 30%, corporate tax rate is 30%, the effective tax rate is less. We are conducting studies by taking the nifty companies, how much the company have paid the tax in the profit and loss account, what is the tax rate applicable to them, what is their effective tax rate. It depends from one sector to another sector. Varieties of sectors, the effective tax rate varies from one sector to, suppose, the automobile company, IT sector, telecom companies. It varies from sector to sector because companies are giving different concessions to different type of companies. There's a very interesting research studies. You also take it up later. If you apply the formula for the previous example, the taxable income is 2 lakh rupees. What is the current year tax? Taxable income multiplied by tax rate. 2 lakh rupees into 25%, you get 50,000. What is the deferred tax asset at the end of the year? Temporary difference, 20,000 into tax rate, 25%. So deferred tax asset is 5,000 rupees. Why there's a temporary difference? Prepaid insurance premium. Insurance amount has been paid in advance. This results in future taxable amount. Okay. Income tax payable, which is equal to current year portion 50,000 minus deferred portion 5,000. This year you are deducting this 5,000 rupees. Later you have to pay. This year 45,000 rupees you are showing. You are paying less amount. But later this 5,000 will be reversed later, the next year. So now I come to the issues and solutions to this deferred tax accounting. The main issues in the deferred tax accounting is dual reporting system. In India, we follow one set of rules and provisions for tax reporting, another set of rules for financial reporting. There are many countries we can include in this dual reporting system. For example, USA, China, Australia, UK. There are many countries, they follow the dual reporting system. You cannot say that the profit you determine of the profit and loss account is the base for tax payable. Companies will not agree for that. Okay, Companies Act, every year Companies Act is amended to give more concessions, to withdraw the concessions, etc. This presence of dual set of account rules results in deferred tax accounting. Why deferred tax accounting arises? Because of dual reporting system. Suppose if you follow single reporting system, presence of single system of reporting will not result in deferred tax accounting at all. Suppose if tomorrow you may amend the act, Income Tax Act, you amend it. Whatever the profit shown by the companies in the profit and loss account is the base for payment of tax. Then there is no difference in the tax payable under the two system, therefore no deferred tax accounting. So do you think that the single reporting regime will come in India? It will never come. We have to have two sets of rules for accounting and tax. Therefore, the major issue for deferred tax accounting is dual reporting regime, which is followed in India. This is India's 12 income taxes. I think if you take an example of tax reporting of Infosys Technologies Limited, how they report. This is an example of earlier year. 2019-20, current income tax of Infosys is 5,235. 2021, 6,013. They have shown the deferred tax minus and plus. Here minus, their liability has been reduced to 4,934. Here 416, 6,429. If you refer to the page number in the annual report, you can see this. Means every annual report of the companies will have notes to accounts. In the notes to account, they give elaborate discussion about deferred income tax and current income tax. Okay, and these are the examples in the annual report of Infosys. If you go through the annual report, you get to the details. I think very interesting notes, you can get it. Okay, this is my presentation. I have completed at 3 o'clock. Another 15 minutes is there for discussion. You please ask any questions.
Is this, sir, good evening, sir.
Yes.
Is this deferred income will be taxed only for the subsequent year, or it will be taxed over a period of time, sir?
No, subsequent year. Every year you carry forward the deferred tax asset and liability. Every year. In the balance sheet, if you see opening balance and closing balance will be planning. Okay. What from the profit, you see the logic here. Suppose from the balance sheet, you take a portion to the profit and loss account. What is that portion? That portion is the difference in the deferred tax asset and deferred tax liability. Every year it will go just like a chain. Understand?
Is it different from deferred revenue expenditure, sir?
No,
We
it is
have-
different. It is different.
Okay.
Deferred revenue expenditure, for example, advertisement expenditure incurred by the company 10,000 crores. The benefit of that will be for next 10 years, company estimates. That is an expenditure incurred today, which cannot be charged to profit and loss account this year, but you can defer the expenditure recognition for next 10 years. That is different.
But the income is only set off to the subsequent year alone, not distributed over a period of time.
Which one?
Deferred income I am referring to, sir.
Which deferred income? Can you give me the example of deferred income?
No, it's
Deferred capital expenditure, you given the advertisement expenditure, preliminary expenses, they are all the examples of deferred expenditure.
revenue. Yes, sir.
They are capital expenditure, you cannot say capital expenditure, you cannot also say revenue expenditure, but it's a revenue expenditure, benefit will be deferred. Therefore, you are allocating to different accounting periods.
Okay, sir.
Can you give the example of deferred income?
Suppose dividend income, you said.
Dividend income received as per the income tax, taxable.
Yeah.
Dividend income is earned but not received. It's earned but not received. Accrual system you have to include in the profit and loss account.
Okay.
Accrual system, accrual system says income earned but not received.
Received.
This is, you have to show it as an income.
That is taxable.
Taxable.
Immediately taxable.
Immediately,
But currently,
current year taxable, but income tax act, next year you will show income received, next year it will come dividend received.
okay.
Okay, there's a difference in the taxable amount, taxable income in this year and the next year, under the two sets of receipt. Yes.
Sir, why the government
Yes.
to insist upon the single reporting system?
No, single reporting system. Basically, suppose we want to encourage industries. You are familiar with the PLI scheme. We want to encourage exports. We want to encourage regional development of industries. Suppose you say, any industry, let's come forward to establish industry in Jammu and Kashmir. Nobody will go to Jammu and Kashmir and establish an industry. Suppose government now says you can go to Jammu and Kashmir, buy land and establish an industry. Definitely the industry wants some tax incentives. doesn't it? Government policy is to encourage regional balance growth of industries. It cannot say that you only develop the industries in Bombay or Bangalore. Okay, government has to use some incentives. These incentives are incorporated in the Income Tax Act. They are not same as per the Companies Act. Okay, definitely in all countries, all governments, their tax rules are different from Companies Act rules. So these differences will be there. If you want to bring single reporting regime, means your geographical location is such a way that suppose you are located in a Bangalore city, very small city. I think you don't want to encourage the development of industries in different areas of Bangalore city. Then you follow single reporting. For example, you think about Germany, a very small country. Germany says that you follow the same system for tax purpose and financial reporting. It's possible, but in India, it's not possible. In UK, it's not possible, or in America, it's not possible. They will be always different. Now, finance minister is preparing budget. Every day, people are lobbying the finance minister to give some concessions. It already started. So we have another 10 days to present. So this lobbying is there because they convince the finance minister that this is going to generate employment. This is going to generate the income tax, later exports, etc. So this is the reason why the single reporting regime cannot be expected near future in India. You cannot expect it.
Okay, sir. But if the same situation is continuous, then how the government can predict the actual tax income?
This is like a bicycle is there. I sit on the bicycle. I have to balance and go. Every day balancing. Finance minister is balancing, prime minister is balancing. It's a balancing. Balancing means either you give some concession, you withdraw some concessions. You see the windfall tax levied by the government of India for oil generating companies. Because of the Ukraine war, oil generating companies, oil producing companies have earned more and more profit. Government levied in a windfall tax, withdrawn windfall tax, depending upon the crude rates. So this is a balancing act. Prime Minister, Finance Minister is doing balancing. That's all. This will continue, just like riding a bicycle. It is not so easy without balancing riding a bicycle or riding the scooter.
Do we expect any income tax exemption?
People, you know, I am also here. I want
because the slab rate was not rising so far. For about 8 years.
Every year we are disappointed. Before budget, we expect something. So exemption limit can be increased to 5 lakh rupees like this. But in India, number of assessees, total population number of assessees is very less. Government will not enhance the exemption limit to 5 lakh rupees or 10 lakh rupees. Government will not do that. Give some concession. Last year they have given plan A, plan B. Okay, like this, they may not give drastic exemptions to small taxpayers like us. We don't expect so much.
Sir, one question, sir.
Yes, yes.
The government pays salary and gets tax on it, and if
Yes.
the money is not withdrawn from the bank, it also gets tax on the interest earned on it. What is your opinion, sir?
What is? Please clarify again.
Sir, government pays salary, sir, and gets tax on it, and if the money is not withdrawn from the bank, it also gets tax on the interest earned on it. What is your opinion, sir?
So this we have to see whether it is a taxable income is taxable or not. Suppose you say salary is given by the company, you are not withdrawn the salary, that lies in the bank account. Interest is paid on the salary. Interest is an income. You have to pay the tax.
Sir, salary people, the business people is okay, sir, but salary people.
But that's why I see in any regime, you know, only the elite people will be benefited. You see the Ambani's wealth has grown many fold for the last 10 years. Whether our wealth has grown, we get one annual increment. How much is the market capitalization of Adani, Ambani? So in any system, the elite people will grow faster than the people in the lower strata or the middle strata. We are in the middle. our income cannot be increased like Adani's income. What is the scale of investment Adani? Suppose now he is going for OFS for other enterprises, 20,000 crores is offering shares. Last year it was only 300 rupees share price, Adani Enterprises. Now it has gone to 3,000 rupees. Now he is going for offer for sale, give 10% discount. If you have purchased a share in the last year for 300 rupees, now if you purchase 3,000 rupees, he give 300 rupees discount. What the retail investors will do? Oh, they are offering 10% discount. He won't compare what is the price in the last year. Last year, 300 rupees has gone to 3,000 rupees plus. This, retail investors are small salary people like us. We must be very vigilant, very careful. Now, so many retail investors are rushing to capital market. Number of demat accounts have been increased. And so many youngsters are joining the stock market. And in the long run, we have to see whether our investors, retail investors are vigilant, are they careful, they study how the companies will work and stock market will work. I don't know how many of us will subscribe to the shares offered by the Adani, 20,000 crores. How much premium I am paying? Compared to the last year's price, this year's price, I have given 10 times. But I believe that I get 10% discount.
Excuse me, sir.
Yes.
Thank you, sir. Thank you, sir.
Sir, whether MAT provision is applicable to all companies or any, or is there?
MAT provision is as per 115 JA Income Tax Act. For deferred tax accounting, you apply the MAT provision, you find the taxable income, total income. You take the total income, which may incorporate MAT provision or may not incorporate MAT provisions. Total income will be taken, and it will be compared to pre-tax accounting or profit before tax up to the financial statements. I think I'm clear.
Right, sir.
MAT provision is applied under the Income Tax Act to find the taxable income.
Right.
Okay, this is as per the provisions 115 JA. So that is one set of reporting that will be compared with the PAT, profit before tax.
Thank you, sir.
We are doing research, our students are doing research on this topic. This is a very interesting topic for accounting and income tax, and very difficult to understand in the beginning. If you understand it, I think you can really enjoy the subject. If you understand, if you do the study the live examples of companies, take the example of companies and how temporary differences can be calculated, how the effective tax, I told you the effective tax rate. Effective tax rate is very less, though statutory tax rate is more.
No, sir, this is Dr. Mohan, sir.
Okay, please.
Mohan Kumar.
Oh, yes.
Sir, in a normal life, whatever we pay, we will get the benefit out of it.
Okay.
Higher we pay, higher the benefit. Lesser we pay, lesser the benefit.
Yes.
When it comes to tax, irrespective of the person whether he pays or not,
yes,
he'll get the same benefit from the government.
Yes.
Do you able to add anything for this, sir?
Anything that means the ability to pay the tax. Who is
Okay.
has ability to pay the tax? If you earn income, you have more ability to pay the tax. A poor person who earns less income, he is not able to pay the tax. Therefore, those earning more income by paying more taxes has to compensate the people who are earning less income and paying less taxes.
Don't you think it is demotivate the person?
No, it will not demotivate. It is egalitarian society. It means those who are earning more have to compensate for those who are earning less. It is not demotivating. It is not discouraging the people who are paying taxes.
Okay. Thank you, sir.
Okay, thank you very much. We take a break and later we go to another topic, budget estimates and accounting for universities and colleges. So thank you.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir. Thank you, sir. Thank you, sir.
Thank you very much, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.